Hello, my dear students, and welcome back. I know, exams are right around the corner, and I've been getting so many messages from you all saying this one chapter is giving you a little bit of tension. But listen to me, you don't have to worry at all. Today, we're going to make this bank reconciliation statement so easy, you'll be teaching your friends. That's my promise to you. Okay, let's just jump right in. Have you ever had this happen? You open your GPay, absolutely sure you have, let's say, 10,000 rupees in there, but it shows only 8,000. That mini heart attack you get for a second, that feeling of where did my money go? Well, that exact same mystery is what big companies face all the time. And today we are going to be detectives and solve this puzzle together. So in any good detective story, you need suspects, right? In our case, we have two main suspects who are telling us two different stories. First, we have the company's own record, the cash book, and second, we have the bank's official record, the passbook. So what's the difference between these two? Well, it all comes down to timing. Just think of the cash book as your own personal diary. The second you give a check to your friend, you write it down, right? You've recorded it. But the passbook, that's the bank's diary. And the bank only writes in it when your friend actually takes that check to the bank and the money moves. You see that gap? That's where our whole mystery begins. Okay, so why does this gap even happen? Is it always some big fraud or a huge mistake? No, not at all. Most of the time, it's just about understanding a few simple clues. So, come on, let's put on our detective hats and start investigating. All the reasons, all of them, can be put into two simple little boxes. First, and this is the most common one, is just timing differences. It's not really a mistake, it's just a delay. Like, we know something before the bank does, or the bank knows something before we do. And the second reason, of course, is plain old errors. Sometimes we might make a small goof up, or hey, even the bank can make a mistake. All right, here's our very first clue. Let's say you write a check and give it to your friend. In your cash book, your diary, you've immediately subtracted the money. But your friend, well, he's busy watching Instagram reels and is just too lazy to go to the bank. So as far as the bank is concerned, that money is still sitting in your account. Your book shows a lower balance, but the bank's book shows a higher balance. See? And now let's look at the complete opposite situation. Someone gives you a check and you run to the bank and deposit it. In your cash book, you're happy. You've added the money. But the bank needs a day or two to actually process that check and get the money from the other person's bank. It's like your check is waiting in a line. So until that's done, the passbook balance won't go up. Now, this is the nice kind of surprise. Sometimes the bank is working for you in the background. It might collect some interest for you or a dividend from some shares you own and put it directly into your account. The passbook balance goes up, and you have no idea about this happy little surprise until you check your statement. And then there's this one. Now, the bank is not a thief, of course. I'm just kidding, but it does take tiny amounts of money for its services, like SMS alert charges or for giving you a new checkbook. It takes the money right from your account, so the passbook balance goes down. And you probably won't even know about it until you look closely at your statement. Okay, so we've got all these clues floating around. Checks that are out there, deposits that are waiting, surprise money from the bank, and tiny charges. It sounds confusing, doesn't it? Well, how do we put it all together? We use our special super detective tool, the Bank Reconciliation Statement, or as we call it, the BRS. Now listen to me very carefully. Do not get scared by this big name. A BRS is not a ledger account. It is not part of your double entry system. It's just a piece of paper. A simple statement like a working note that we create just to figure out why the two balances are different and to make them match. That's all it is. Nothing to be scared of. So how does this super tool work? It's just pure logic, Beta. Look, we start with the balance from our own book, the cash book. Then we think, what does the bank know that we don't? Well, it knows about that interest it collected, so we add that. What else? Oh, that check we gave our friend, which he hasn't cashed, the money is still in the bank, right? So we add that back too. Then we think, what have we recorded that the bank hasn't? That check we deposited, but it's not cleared, so we have to subtract it for now. And those bank charges, the bank has already taken the money, so we have to subtract that too. And when we do all this adding and subtracting, poof, we should land on the exact balance as per the passbook. It's like magic. All this theory is great, but there's nothing like solving a real problem, right? So let's get our hands dirty and solve an actual case from your textbook. We'll do it together, one step at a time. All right, detectives, open the case file. Here's the situation. A certain Mr. Vinod looks at his cash book, and it shows a nice, healthy balance of 50,000 rupees. But we have a few clues that tell us his passbook is showing something different. Our mission, should we choose to accept it, is to find the passbook balance. Okay, let's break this down. We start with what we know, 50,000 rupees in the cash book. Now, clue number 1, checks issued but not presented, 6,000 rupees. We've reduced our balance, but the bank hasn't. To match the bank, we need to add it back, so plus 6,000. Next, a dividend of 8,000 rupees was collected by the bank. The bank's balance is higher because of this, but we don't know about it yet, so to match them, we also add 8,000. Good so far? Now for the minus items. A check we deposited for 6,000 hasn't been credited. We already added it in our book, but the bank hasn't. So to go back to their balance, we must subtract it, minus 6,000. And finally, bank charges of 400. The bank has already taken this money, so their balance is lower. We need to lower our balance too, so minus 400. So we take our 50,000, we add the 6 and the 8, and then we subtract the 6 and the 400, and what do we get? 57,600 rupees. And just like that, case solved. That's the balance in Mr. Vinod's passbook. See, it's not hard at all, is it? Just a simple puzzle. You all did so well on that. I'm so proud of you. Now let's do a quick, super fast revision round, just to make sure this is all perfectly clear for your exams. Are you ready? Okay, here is a classic exam-style question for you. Read it carefully. True or false? When we are preparing the BRS, bank charges that are in the passbook but not our cash book will increase the cash book balance. What do you think? True or false? If you said false, you are 100% correct. Give yourself a pat on the back. Of course it's false. Bank charges are a deduction, an expense. The bank has taken money, making the passbook balance lower. So to match it, we must also deduct it from our cash book balance. It will decrease our balance, not increase it. And there you have it. See, I told you it was simple. Accountancy is nothing but common sense and simple logic. It's just like solving a fun puzzle. Please don't ever be scared of it. You are all so smart, and I know how hard you've been working. You've absolutely got this. From the bottom of my heart, all the very, very best for your exams.